In this video, I'm going to show you start to finish how you can consistently, safely, and most importantly, passively make $5,000 or even $10,000 a month running the wheel strategy on any stock of your choosing. But in this video specifically, we're going to look at Palantir. This is just one of the many strategies I teach my students in the Discord, which is why they're making consistent profits week after week, month after month. If you guys enjoy the strategies in this video and you want to learn even more from me, you can join Discord at any time. Links in the information box below. Before we dive into this awesome strategy, stick around. Don't skip any parts of this video because it's critical to understand each step to understand and gauge stocks properly and make passive, consistent income and have consistent wins. But not only that, in this video, I'll also show you two very powerful strategies, how to chase losses and hedge a position where the stock goes against you on puts. So stick around for both of those strategies in this video. Watch this video in its entirety so that you guys can understand every aspect, because what I'm going to teach you in this video is very powerful and you do not want to miss any of it. So let's get started. We're going to look at Palantir. So the first thing we need to do is we need to gauge where is a good entry point. So first thing we need to look at is if this is a good company, if it's profitable. And if the company is profitable, that's great. If they're not, we have to gauge their potential future for profits. And once we gauge if the company is strong, then we move to the next step to figure out price action, where the stock is, where it's likely to go. Then we can set up our strategy to start making profits. First, we have to look at Palantir, and we already know Palantir is good, but we're going to go through these motions so that if you're new, you can understand how to do this properly. First thing we want to look at is price to earnings. Pretty much anything under 50 is decent. Anything under 30 is pretty good. Under 25 is great. Under 20 is really great. Almost perfect, like literally almost perfect. However, Palantir has a 569. So let's go ahead and gauge the price to sales. Essentially, what price to sales gives us is a metric to calculate a company's ability and high probability of becoming profitable in the near future. In order to get that metric, what we do is we take the market cap, which is $264 billion, and we're going to divide that by the trailing 12-month revenue. And what we're going to do is go over here to the income statement, and the trailing 12-month is 287. So we are going to divide 264 divided by 2.87, giving us a price to sales of 91. Now, this is really not that good because price to sales on Apple is around 12. Tesla's is like 19 or 20, maybe a little higher. Anywhere between 10 and 20 is average, pretty much where most companies are going to fall into. Some a little higher, some a little lower. As an example, SoFi was around 1.9 this time last year. And I explained that most companies that low rapidly grow into their valuation and should likely be 2 to 3x. SoFi went from $6 to $18, where it then had a price to sales of 6.1 or 6.2. Now they're back down to 12. They have a price to sales of just under 4. So essentially, SoFi still has about 2 or 3x on the table in the next year or two. Palantir, on the other hand, has a price to sales of 91. Now this number's kind of skewed for Palantir because their growth has been pretty rapid, but at this point in time, the valuation that I'm getting is not the greatest as far as price to sales and price to earnings. When we look at their overall revenue, just as revenue alone, it's good. Gross profit is good. They have $2.3 billion in gross profits trailing 12 month. Their operating income is also $310 million, which is pretty good. Pre-tax income's $500 million a year. Overall, consistent to the quarters, very good. Net income, almost $500 million, $80 million a quarter. This quarter was a little bit lower than the previous ones, or like the last quarter. So this last quarter was a little bit less than the ones that preceded it. However, it's still pretty decent. Next, we look at EBITDA, which is a very strong metric. And this is earnings before interest, taxes, depreciation, and amortization. We already know what taxes are and interest, and we already know what depreciation is, but amortization is the ability to spread debt. So when you buy a car and you finance it and you pay a monthly payment, that's amortized debt. Your mortgage, that is amortized debt. So you could have $1,000 a week coming in, making $4,000 a month, and that is healthy even if you owe $35,000 in debt, because you can amortize that debt over 5 years, and it ends up coming out to somewhere in the $500 a month when you're making $4,000 a month. So amortization, very important. EBITDA is very important. So these are strong metrics, but this recent quarter was absolutely terrible compared to the previous quarters. When we look at the balance sheet, total assets cover liabilities quite easily, 6-1. Total debt, very low, and their net debt is negative $5 billion. So if you have a negative net debt number that's non-existent, it means they actually have cash. So to keep it simple, every time you see a negative number beside net debt, that means that's how much money they have in cash with no debt. Palantir has $5 billion in cash. So while their income statement may be lackluster in certain areas, their price to sales, not so good. Price to earnings, not so good. They have $5 billion in cash and a lot of government contracts, one of which is $500 million with Project Maven, and they have many others. They also have a pretty equal balance between commercial and government businesses. So if there's geopolitical issues, Palantir will do well. If there's no geopolitical issues, they'll do very well because of the commercial side of business. So they're poised to be very strong no matter what. And Foundry is also very strong. Palantir is able to integrate and get management done for businesses quicker than any human could ever do it. Like, we're talking 3, 4, 5 weeks where the work can be done in days. Palantir can fully integrate in like 10 hours. So this is something to think about. Great company, a lot of future potential. It's just that the price to sales and price to earnings right now are not reflecting it, but it very well could grow into its evaluation. We will find out on the next earnings, which is 7 days out, and they have beaten every earnings call leading up. So overall, there's a lot of strength. And when you look at future guidance, it is worth its current price if it eventually gets financially and contractually where it needs to be and where it should go and where analysts are saying it will go. As long as all of that works out, everything is good with Palantir. And Palantir hasn't even reached its full potential. As it was climbing to the $125 range, it was stopped in its tracks by President Trump and the tariffs. So it hasn't really had a chance to flourish and break above 125. Look at this right here. Look at this strength. After all the selling in the market going down, is just breaking back through all of this. And if earnings crush, it is going to fly. When you look at a stock like this, we have to understand, where is the bottom? Where is the bottom likely to be? Worst case, where is this stock likely to go at worst case scenario? So when we look at that, we understand that over here, there's a lot of interest. A lot. Top, bottom, pretty much between $70 and $82. There's a lot of buying pressure in here. So if the stock was to ever fall into this range, it would get bought up. I don't see Palantir going below $70 unless earnings is a complete bust. And we have other geopolitical issues and other bad news and tariff talks. It would take a lot to get Palantir below 70. Not saying that can't happen, but it's pretty unlikely, rather unlikely. So we're looking at this right now, and that's what I would come up with, that it's pretty much not going to happen because of all the confluence in here and the average price from all the way up here to all the way down here. It spends a lot of time in the 75, 80 range. That's like the midpoint. So when we look at these prices here, we can see that the moment Palantir touched 71, just like I said in here, got bought up. Then they tried to force it down again. The market was really bad. There's a lot of manipulation. As soon as it touched 65, deep into this area, almost similar to a liquidity grab, it bought up real quick and went all the way back up. So it's safe to say right here at 75, all the way to 80 is a pretty solid bottom. Now, you're probably thinking, well, that's great, but I can't sell put options going out a week or two and get great money for a $75 put. Well, no, you can't. I would say that it's okay to sell put options based on this data around $80 to $88, somewhere in the 80 to 90 range, really. But I prefer to be around 80 to 85. And if you go out 2 weeks or 3 weeks, the premium will be decent. If you go out a month, it will be even better. And typically, when you have a stock like this, if it beats earnings or it just meets expectations, the stock is highly unlikely to go below $91, which you can see there's a peak here, a couple of peaks here, dipped through, and it broke back down. It resisted there. And then when it finally broke through, it became support. The ceiling of 91 became the support at 91 right here. So you can see ceiling, another ceiling, and now it's support. So pretty much $90 is now the support. So to be safe, we go $1 or $2 below, $88, very safe. We got earnings coming up, so $88 is going to be $24 out of the money. So we're going to look look at Palantir and the options chain, and I'm going to show you guys how to gauge this to make consistent money while doing very little and not having to manage your portfolio. So let's go and look at 88. You can see $88 puts are only worth $10 going 4 days out. But if we go a month out, $88 puts are probably going to be worth a decent amount. So $2.71, which is $271. So this is actually quite good and very safe. If we go out 2 weeks or just under 2 weeks, we can see that $88 is $159. So essentially you get pretty close to $250 to $300 a month per option going to 88. 88 is going to be a delta of 11 2 weeks out. If we go a month out, then 88 is going to be roughly 15 delta. Now, when you look at delta, there's two ways to look at it. The delta gives you the percentage chance roughly of what a stock is like to go there. So if the delta is 15, it's 15% likely that you'd be assigned at that price. Also, 15 delta means when you're buying long options like calls or puts, the delta correlates to how many shares you're essentially controlling. So if you buy a call contract that has a delta of 40, then it's the same as holding 40 shares, because if the stock goes up $1 and the delta is 40, the call option goes up 40 cents. So just to give you guys a little bit of an understanding of delta, and then of course gamma, every dollar gets added to delta. So delta progressively and exponentially goes up, and the value of the options go up or down depending on the stock price movement. So what we want to do is we want to look at Palantir and figure out what is the best course of action here. And because of earnings and because of their history beating earnings and because of the FOMO on Palantir and the future guidance and the massive growth and breaking out of this downtrend, even though it's overbought, I calculate that 90 is fairly safe going 2 weeks out, and so is 92, because if you get assigned at 92, you're not really spending 92, are you? So let's go ahead and look at these 2 week options, and we're going to go to 90. You can see this is 246 and 92 is 283. 92 has a delta of 17, which is very safe. We could get away with a 92. I would think that 94 at 19 delta is a little risky. So we're going to play it safer, and we're going to probably stagger this half at 92, half at 90. So what we're going to do is we are going to sell 5 contracts. We'll get about maybe we'll get $3 because that's the midpoint. So we're going to get roughly $1,500 for these contracts. So let's get this in the calculator. We're looking at $1,500 for 2 weeks. Plus we are going to stagger and sell 90s as well. So 5 of these, and we'll get maybe $250 for these. It's right in the midpoint. All right. So there you go. $1,250. So we're going to add $1,250. So in 2 weeks, we get $2,750 times this by 2. It's for the month. We get $5,500. If you sell these put options for a month and then get assigned, this would be 1,000 shares. So you divide 5,500 by 1,000, giving you $5.50 off of every share. So to find your average cost, you have 500 shares at 90 and 500 shares at 92, which essentially gives you 1,000 shares at 91 because they're equal. 500 and 500 is 50-50. And if you have 50-50 between 90 and 92, the price in the middle is 91. So $91 at 1,000 shares. But then you got to take away 550. So 91 minus 550. You only have to sell the 92 and the 90 puts for 2 weeks. And if you don't get assigned, sell for 2 more weeks. If you get assigned on the second set of puts at the end of the month, your average cost is $85.50, which is really good. Essentially, if you were to sell 90 and 88, well, then you would have an average cost of closer to 83, which is even better. Now, when we look at this, if this was to happen, then the stock came down to like 89, 88. As long as it is above or equal to 85, which is down here, right in the middle of this, which is perfect, you're at break even. Even if the stock drops to 79 or 80, you're only $5 out. Because of the premium we collected, we are in the mid right here. Now I'm going to show you guys a very quick explanation on a powerful and easy strategy to understand, something I've taught my students in Discord, which has helped them make consistent, safe profits and helps them be even more consistent than just running the wheel strategy by itself. If you enjoy this strategy and explanation and you want to learn even more, like I said, you can join my Discord, 2 coaching calls per week. You can follow all of my trades, 6 hours of video on-demand training, and an Ask Corey section where you have access to me 24/7. I would love to help you. It's what drives me every single day. You can join. The link is in the information box below, investwithcorey.com. Just click on training, and you'll be able to book a call with my team and I so that I can help you grow your portfolio. Like I said, I already have a lot of money. It doesn't drive me anymore. It used to, but what drives me is accomplishments. And my accomplishments that I aspire to be great at is helping you and others just like yourself. So I hope to see you soon in the Discord. Now, this strategy that I'm going to show you, let's say that you want more premium and you're afraid the stock's going to go up, chasing bigger wins, right? So if you sell these puts for 2 weeks, what do you do if Palantir goes to 120? Now, in order to sell puts for 2 more weeks, you can't sell 90. You have to sell 95 or 98. So what you're going to do here is go out a month, collect all that juicy premium up front, and when the stock goes up, it depletes in value rapidly, and you don't have to go out 2 weeks from now and start selling 98 puts. You can hold on to these 90 and 92 puts, and you will have a lot more money. So for example, we go a month out and we sell a 90 and a 92. The 92 is going to get us about 373 roughly. So we're going to get about 1850. And then we're going to sell the 90, which is going to get us roughly 325. We might get 328 for it. 1625. So we're making about $2,000 less, but if the stock was to run all the way up to like 125, we would end up putting ourselves in a position in 2 weeks from now that we would have to sell $96 to $98 puts or even $100 puts. But right now, by doing this, it gives us more money up front. And if the stock does move to 125, these 90 and 92 puts will be 80% worthless when that move happens. So on earnings, if Palantir goes to 125, you'll make 80% of this profit in the first week, 3 weeks ahead of schedule. So sure, it's about 20% less profit than doing it the other way, but you're going to make this profit potentially 2 or 3 times faster. This is something to really consider. If you expect a really big move, you might as well take more premium up front, because if that's likely to happen, you make a little bit less if you were to sell 2 separate times in the month, a bi-weekly and a bi-weekly. So 2 weeks and 2 weeks, you make less by selling the entire month, but you get more upfront right now. So instead of making $2,500 for 2 weeks, then $2,500 for 2 weeks, you get $3,500 up front. The stock moves way higher than anyone would expect. You collect $3,500 up front, then the stock moves, and you make that in days or a week instead of a month. So it's a little bit less, but quicker and safer. This is a very powerful strategy that I like to utilize, especially during earnings. So now we get assigned on Palantir. And let's say we have $5,000 from puts originally. If the stock, let's say, had come down to somewhere in the 85 or 88 range and we're just at break even, then it's fine to go above and start selling call options, maybe $2 or $3 above our entry at 90 and 92. So we could pretty much sell 93 and 95, which would be right here and right here, or maybe in 96, 93 and 96. If the stock was to have dropped down to 79 or 80, well, then we have to be careful, because if we sell call options at 85 or 83, then we're going to be in a position where we're barely going to break even. When a stock drops like this, I typically like to wait for it to flatten out and consolidate and start to move up again. Sometimes I will chase this loss, and if the stock starts to come down, I will sell covered calls at break even at 85 going 2 or 3 weeks out, and then I'll sell put options down here. And if the stock looks like I'm going to get a sign in the puts, that's okay, because then I can buy back the calls for pretty much nothing. And that profit plus the premium of the puts go together. So for example, in this scenario, if the stock was to drop to 79 or 78, I could sell $85 call options for 2 weeks. It'd be the equivalent of selling a 118 right now. And we can see that they would be 615. And if we look at 615, this also encompasses earnings. They're probably more or less, if we look at the implied volatility, it's about 30-40% higher. So with Vega being 0.08, basically, it would be safe to say that these options would be worth 400, essentially. Let's just say 400. Roughly, that's what they would be outside of earnings. So we have $400 times 10, we'd make $4,000, okay? And then what we do is we go down and sell $70 puts if the stock was at 79, which is $9 out of the money, the equivalent of selling roughly 105, 104 puts. So this would be like $300. So we have $4,000 from those covered calls because we have 10 contracts. And now we'll sell maybe 5 put options at 70. If the stock was hypothetically at 79, just like we had discussed here, if it dropped down, we've sold. As soon as we start to see it drop, we sell $85 call options, like I said, which was $6 out of the money, which is around $4,000 of 10 contracts. And now we're going to be looking at selling $70 puts, which is $9 below that hypothetical price, which is the equivalent of selling 103s right now. It's worth about $300. We sell 5 of those, which is $1,500. So we'd make about $5,500 for 2 weeks. Even if we got a sign on those 5 put options, we would have $5,500 from the calls and the puts because the calls would be worthless. And we divide that by 500 shares. So essentially we'd have $11 per share discount. So if we got assigned the shares at 70 minus 11, our average cost is actually 59. This is how we chase losses. And this is just one of the ways to do that. If you want to learn more on loss aversion and chasing losses, comment below and I'll make a video dedicated to that. Lots of people, in fact, almost everybody has loss aversion. They want to avoid losses and not chase them down head on. Think of it like someone trying to break in your house. Are you going to run and scream with your back to them? Oh my God, don't chase me. Hit me in the back. I'm wide open. Would you really do that? Well, that's loss aversion. Chasing losses is standing beside your door with the lights out with a baseball bat, waiting for them to walk in the door so you can clobber them, essentially. That's what we're doing. We're hunting the losses down so they can't get us in the back. And it works like a charm if you know how to do it. So now that's just that scenario. If the stock continues to consolidate after getting assigned, then starts to, move its way up, we will go ahead and we will sell call options at 97, 99, 100, wherever you really want. But typically I look at the previous highs, and right here we can see the previous high was 108. Now we've already broken that and we're up here at a break of structure at 112. So the next high previously is 125. So if we get assigned at 85 and the stock's down here and starts to come back up, there's a lot of resistance here at 108 and at 98. So I would sell 110 call options, which essentially would be about $20 out of the money, which would be the equivalent of selling 132 right now. So if we were to go out for 2 weeks and sell $132 call options, they don't have it, only 130 outside of earnings, this would essentially be around $250. So we could make about $500 a month times 10. So about $5,000 a month. So we made $5,000 on the puts for the first month, $5,000 a month on the second month for the call options. And then if we were to get assigned on our third month, we would add another $5,000 plus the original $5,000 we made from the put options. And now we get assigned. We entered at 90 and 92. And now we're exiting at 110, hypothetically, in the scenario if the stock was to come back down. So we're essentially getting $19 per share. So 19 times 1,000, we would make $34,000 in 3 months. So essentially $10,000 a month. If you do this for the whole year, you're likely to get assigned on puts multiple times, and you're likely to get assigned on call options potentially once or twice, maybe more, but roughly once or twice per year, depending on how you gauge the stock. So this is going to average out to around $11,000 a month. And then maybe one put assignment per year, that would be okay. You'd have $34,000 for 1 quarter. And then for the other 8 months, you would just make $40,000. 8 times 5,000 is $40,000 plus $34,000 from your first quarter. So essentially, if you're just selling covered calls all year round and you only got assigned on your puts in your first month and your calls in your third month, and that's it, and then you sell puts to get right back in again, but you never get assigned on your calls. Puts to get in, 3 months later, calls to get out, and then you immediately sell puts to get back in, but then you never get assigned on your puts. Or if you do and then don't get assigned on your calls, it doesn't matter. When you look at it, it's about $74,000 a year divided by 12, which is $6,000. So between $5,000 to $10,000 a month, depending on how you play the strategy. And I will tell you that you're likely to get assigned 2 to 3 times on puts for the year, calls once or twice. So, You sell put options for a month or two, get assigned, sell call options for a couple of months, you'll get assigned. Then maybe another month or two of puts, you'll get assigned again. Then you'll just be selling call options to get assigned again. And a lot of the times it'll take several months to get assigned on those second calls, just depending on, the stock price action and where the stock goes. So essentially, this is a $74,000 return per year. So it's about 70% per year, 50 to 70% per year, which is very powerful. Palantir is a great stock, and running the wheels strategy is very powerful. Like I said, this is something I teach to my students consistently. It is the safest way to generate passive income as long as you understand the fundamentals that I showed you in this video. How to evaluate a company, if they're profitable, do they have profitability in their near future? You can gauge that with the metrics I showed you and the calculations that I showed you. There's a formula to this. And then you have to look at the charts and understand the price action of where the stock has been, where it's likely to go, where it currently sits, and gauge where you're willing to get in and where you're willing to get out, and then you execute. If you enjoyed this strategy and you want to see more on chasing losses, comment below and I'll make a video on that. If you guys enjoyed the strategies in this video and you want to learn more from me, join my Discord, have access to me, grow your portfolio even more, and make more safe passive income. And maybe you want to retire early. I would love to help you. It's what drives me every single day. It's what I enjoy the most, is helping people just like you. Investwithcorey.com. Links in the information box below. Click on training, book a call with my team and I, so I can help you. And I look forward to seeing you real soon. Take care of yourselves, fam.